Okay, we're ready to move on to the basics of supply and demand. We're conditioned through education and trading books to buy when the price is high and sell when the price is low. This is the investment advice instilled in us from an early age. Buy stocks when they are rising, they can only go higher. And more often than not, punters end up selling their shares at knockdown prices when the price plummets and the pain to hold them is just too much. The same applies to Forex, commodities, futures and any other market you care to mention. Yet in every other aspect of our lives, we buy when something is a bargain and try and sell it for as high a price as we can get. So why should this be any different in trading? It shouldn't, and this is where the professionals differ from the retail crowd. They buy low and sell high, just as your local car dealership might do. The pros buy at wholesale prices and sell to the public at retail prices. At this point, a transfer of funds takes place from retail traders' accounts to the pros. The point at which this takes place is often what we call a supply or demand zone. And this diagram visualizes the supply and demand cycle, where the smart money is selling at the top, retail comes in at the bottom and sells, at the same time that smart money is buying. When the price rises, retail start buying and smart money sells again, and this cycle just continues over and over again. Buying at a demand zone. A supply or demand zone can only be seen once price speeds away from an area on the chart. It indicates there was professional buying or selling interest at the origin of that move. So, we have price in a little range here, and it takes off. Now, at the point it takes off, we can now say that this was a demand zone. At this point, the retail traders see the price taking off and they buy too late. But the professionals note that there was buying interest at the demand zone. Price then comes back to the demand zone, and the retail trader closes their position in frustration that the price has fallen, but the professional has a buy order waiting at the zone. So what will then happen is we'll get in with our trade, we'll buy at this point, and we'll hope that price will then take off. Supply zones follow the same principle in reverse. So we're looking for a very fast move away from a zone. So at this point we now have a supply zone. So the retail trader will see price falling and they'll sell too late. The professional notes selling interest from the supply zone. So there were people who were interested in selling from that level. When price comes back, the retail trader closes their position in frustration that the price has risen against them, and the professional has a sell order waiting here. So the idea is that we would sell at this point and then price would move in our direction. Our job is not to follow the novice traders and chase a move, but to wait for price to return to the zone where we can buy or sell at a wholesale price. Okay, let's talk about a bullish reversal. In this pictorial representation of a demand zone, price dropped, made a base and rallied away very fast. This indicates there was a lot of buying pressure at the base. So, price drops, makes a base, and rallies away quickly. At the point price rallies away quickly, we have a demand zone, and we'll buy on a return to the demand zone. So, if I were to ask you whether the big traders and banks all managed to get their orders filled before this move, the answer would have to be no. There'd be a stack of buy orders all waiting to be filled once price retraced back to the demand zone, which is where we too would be looking to buy. Let's move on to bearish reversal. Supply zones are the same concept in reverse. Price rallied, made a base, and the traders couldn't sell quick enough. When price comes back to that supply zone, you want to be a seller. So, price rallies, makes a base, and then falls very quickly. And that's our supply zone. So, we sell on a return to the supply zone. We're on the Euro USD 15-minute chart here, and I'm going to show you some supply and demand zones, or bearish and bullish reversals. So let's get the drawing tool the rectangle, and there's one here. So the candle bodies end here and there are wicks here. So the demand zone would be drawn like this, and you'd have your stop loss just below, and you'd enter when price came back to the top of the demand zone. So it came back and bounced off, and that would have given you a nice profit. Now, why did it turn over here? Well, there's a supply zone here. Now, this is not a supply zone that I would sell from, and you'll find out why later in the course, but it is a place to take a first scale or take some profit. And as you can see, price moved away very quickly and it then bounced off of the supply zone. And you can see that it's working away at the demand zone orders here. So we spiked again, came back up until it finally broke through on the third attempt. Okay, so there's also a demand zone here. I'll get my rectangle tool and we'll use the bottom of the wicks. This is where our stop loss will be. And I'm going to take it up to here, and I'll show you why. Because the price retraced, you can see this wick, and on a lower time frame that would be a little retracement where price retraced and it shot off from this point here. So that's where I would buy. And you can see that price did go up from the demand zone until it hit supply over here. This is not that clear to see, but I'll draw it for you. So you could take it up to here on a lower time frame, or up to here. Probably the safest thing to do would be to enclose this whole area, which would not give you good risk reward, and I wouldn't take this trade. But you can see that there was a fast move down and price spiked it and retraced off of it. I've got another supply zone to show you over here. Get the rectangle tool, and this is the wick, and the candle bodies come down to about here. So I'll extend it across. So your stop loss would be above the wick. There was a fast move away from the candle bodies and price came back and retested almost to the pip, and this is where you would sell. Now, you probably could have got a 2-to-1 reward here, but why did it bounce here and not go any further? Well, there's a demand zone here. It's not a very pretty one. It may look better on the lower time frames, but you can see that there was a fast move from this point. There's the wick, so the stop loss would have to be here, which isn't very good risk reward. And price came back, almost retested to the pip, came back again, and a third time, and it's eating away at those buy orders until it finally breaks through. Okay, let's move on to the next section of this lesson. Bearish continuation. There's another type of supply or demand zone which is in line with the current flow. In this example, the market drops, forms a base and makes a second drop. The consolidation of candles that it leaves behind becomes our supply zone. So, the market drops, forms a base, and then drops again. Now, the point where it drops again from our base becomes a supply zone, and we sell on a return to that zone. The bullish continuation is the exact opposite of a bearish continuation. The market rallies, forms a base, and makes a second rally. This time the consolidation of candles that it leaves behind becomes our demand zone. And as price returns back to the base, we buy. So this is a very clear example of a bullish continuation on the 5-minute gold chart. So what happened was price shot up, it based, and then it shot up again. So we had the rally, base, rally. And I can draw the zone like this. So this is the wick. You would have had your stop loss below here, and this is where price shot up. So you would have bought here. And you may have had to been a little bit lucky because price came within one less pip than the zone. But as you can see, it took off quite nicely. Now there's another example of a bullish continuation. And just to show you, it's more of an art than a science. Price grinded up. It wasn't a very nice move up, but it did grind up and it did base before it shot up. And these are a bit harder to spot, but I would probably draw it like this, where it retraced here, the fast move happened like that, and this candle base, this basing here, would be enough to contain my stop loss below that. And as you can see, price did move up off of it. Now, why did price stop? Well, there was a supply zone over here, and on the lower time frame you could probably draw one like that, and on the higher time frame your supply zone might encompass the whole area. As you can see, price did react off of the smaller time frame supply zone and off of the bigger time frame supply zone. This is an example of a bearish continuation, so in other words, a drop base drop. And I'll just draw that in for you. So this was the top of our zone. The bottom of our zone was, I would say, here where the fast move happened. So price dropped, based, and dropped again, and it dropped from this point here. That's where the fast move happened. And as you can see, price bounced off of that supply zone. And it's a very strong zone because it bounced off a number of times. If I extend that zone, you can see that it kept on eating away at those orders in that supply zone. Okay, let's move on to the next part of the lesson. A common question that I get is, how many candles should a base consist of before making the fast move? The smaller and less obvious a base is, i.e. the less candles in the base, the more likely it is to work. Conversely, when a base starts to look like a consolidation range, it's no longer a base. So in other words, lots of candles. Experience will tell you which of the cases apply. Basically, if it looks like buyers and sellers are trapped in a consolidation range, it's not a base. The correct way to draw zones. In order to draw a supply zone, position a horizontal line below the candle bodies. This will serve as your sell entry point. Then draw a line across the highest candle wick. Your stop loss will go a few pips above this point. The opposite is true of a demand zone. Draw the top line, your entry, against the candle bodies. Draw the bottom line below the candle wicks. Your stop loss will be a pip or two below this line. The last two slides were perfect examples, but what if your zone looks like this? In this case, we didn't have a perfect line of candles to draw the top of the zone. What we do is draw a line where price took off quickly and didn't look back. There should be little or no retracements. Here's another example with a very subtle difference. The circled wick is a retracement on a lower time frame. It didn't actually shoot up until it passed the orange line. If you drill down the time frames, there would be a bunch of down and up candles where the wick is. So you could have an order to buy at the orange line, but there is nothing wrong with having an order at the yellow line either. It all depends on your risk, which we will cover later. Sometimes price will bounce exactly where you think, other times you'll miss the trade, and sometimes it will bounce deep into a zone. So trading is more an art than a science. And finally in this section, a quick note about zooming out for the bigger view. Always zoom out when looking at charts. It's amazing how many traders look at a letterbox view of their charts and can't see the world around. Read it like a map. So in this chart, we don't get many clues as to where price has been, where the support resistance levels are, and the supply and demand zones. It's a letterbox view. But this chart is a wider view. It's been zoomed out. You can barely see the candles, but you can pick out all the supply and demand zones, all the support and resistance levels. This is what we want to look at. Time to review what we've done so far. We've covered the basics, and you should now be able to understand, identify and draw support and resistance. Recognize and draw trend lines, bull and bear channels. Know the difference between bearish reversal, bullish reversal, bearish continuation and bullish continuation. Draw supply and demand zones and additionally know where to place your stop loss. It takes time to train your eye to recognise these patterns, so don't worry if they are hard to see on the real chart at first, just keep practicing. Okay, if you're ready, let's move on to the next section.